This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I definitely have an itch that I want to scratch today. And as I sometimes like to do, I'm pulling a lot of different sources today to paint a picture, to paint a story. First, let me jump right in. I want to read a piece about CNBC. And of course, I have a history of picking on CNBC. This is a fantastic blog post. And the reality is, CNBC says more about all of us than it does about CNBC. Let me read this piece, and you will see my point. This piece is written by Doug Litowitz, called CNBC Demystified. CNBC presents a paradox in the hedge fund community. It plays constantly, but hardly anybody watches it. The channel mostly functions as white noise emanating from wall-mounted monitors on trading floors and in financial firms. Given its ubiquity, one might think it was highly regarded. But traders and portfolio managers treat CNBC with scorn or indifference. Few rely on CNBC for market information, preferring Bloomberg terminals or proprietary data sources. The situation resembles George Orwell's 1984, where the protagonist, Winston Smith, tuned out the massive telescreen on his apartment wall that issued endless streams of positive news. As an experiment, I polled several friends who have a combined 100 years of experience in hedge funds. They couldn't recall anyone saying, quote, "I just got a game-changing idea on CNBC," end quote. And during rare mentions of the channel, the commentator opines on the female anchor's attractiveness or the quality of the male anchor's suits. According to Nielsen, CNBC commands a market share many multiples of its nearest competitor, Fox Business News, and perhaps a dozen times that of its second competitor, the more elite Bloomberg Television. This is puzzling. How can something so unpopular be so popular? The answer is complex and requires a deep dive to find CNBC's true purpose. CNBC is a news show, or in other words, it is supposed to provide content, information, and stock market advice. By journalistic standards, it falls short of its task. Interviews feature softball sessions bordering on hero worship. The recent coverage in Davos at the World Economic Forum was shameless. Too often, CNBC accepts a devil's bargain where they gain access to market leaders in return for tacit agreement to refrain from tough questions. The experts are self-anointed. Their predictions are never back-tested. And whatever news it provides is already stale to market makers. The screen is full of dizzying information without meaningful analysis. And commentators never broach broader social issues. It's hollow, unconvincing among its anchors. And whenever the market goes down or a guest becomes bearish, the anchors turn incredulous, brittle, defensive, and dumbfounded. Last fall, the anchors turned aggressive on Peter Schiff by forcing him to admit he wrongly predicted that gold prices would rise, and he had to defend himself by noting that he was correct about predicting the housing crisis while CNBC was busy cheerleading. Exasperated, he said what everyone is thinking, quote, "All you do is parade people who are wrong," end quote. Judged as a news show that is supposed to report objectively on the economy and the stock market, it is grievously flawed. But at a deeper level, below consciousness, CNBC serves an indispensable shamanistic function, providing a kind of ideological placebo that calms everyone down by offering a series of comforting myths. Let me interject for a moment. This is why I wanted to read this piece. That starts to be the payoff right there. But at a deeper level, below consciousness, CNBC serves an indispensable shamanistic function, providing a kind of ideological placebo that calms everyone down by offering a series of comforting myths. What a great fucking line. Let me continue. At this, it succeeds wildly. Recall that the function of a shaman is to give puzzled victims a narrative framework for redemption, a story in which their afflictions can be warded off and blessings bestowed, if they perform a certain ritual or appease a demon or ingest a magical substance. A person who consults a shaman does not seek evidence or backtesting. He wants a comforting myth that casts himself as the master of his destiny when things go well, and as a blameless victim of the gods when things go wrong. CNBC, thus, is an electronic shaman for investors. Even with the sound turned off, it sends the underlying message that a master plan exists, and we can find redemption in the markets, that there is a golden thread, a controlling logic to the chaos and indeterminacy around us. When we make money, it is because we have been wise and followed their sage advice. And when we don't make money, when they fail to predict the next collapse, there will be no one to blame because it was due to unforeseeable and mysterious forces. This is what we want to hear. Damn, that's such a good line, right? This is what we want to hear. I don't want to hear this, and I know many of you don't want to hear it, but to me, it's fascinating, not just as a typical CNBC bashing, but to really get into the psychology of why these shows, to break it down. What the hell is going on a psychological level, perhaps a unconscious, subconscious level? So this is what we want to hear. All of us, from amateur investors to the greatest traders at the best hedge funds, on some unconscious level want to believe this. It is not simply that we want to hear that market indices are rising, that may or may not be good news depending on one's positions. Rather, we want to hear that whatever our strategy happens to be, there are well-dressed, positive, cheerful, and confident people telling us that destiny is in our hands and that the dream is within reach. No one wants to hear that we are throwing hard-earned money to the cruel winds of malevolent and opaque forces, that billions, even trillions, are sloshing around vulnerable to unstable geopolitical and sociological events that defy rationality, or that fortunes can be won or lost because of some freak tragedy. No one wants to hear that the market is propped up by the Federal Reserve, or that we are irrationally exuberant, or that earnings guidance is low-grade fiction. What a great line, right? Low-grade fiction. Love it. We want to be reassured by serious men and women in suits who tell us that our events are looking up, that problems are solvable, that the market is rational, that we are scientists and we're not gamblers. And most important, we can all be winners if we just listen to their experts on shows like Fast Money and Mad Money, just as the audience at the magic show suspends disbelief. While the magician saws a body in half, the CNBC viewers suspend disbelief about whether the experts on the screen were correct yesterday or the day before or the month before. Great point. No one follows up any of this. It's just bullshit on top of bullshit, and it never freaking ends. Continuing. To watch CNBC, even volume turned off, is to be transported to a world where propitious events are on the horizon, where people are busy, serious, and sober. The people are smiling, boarding planes, presenting charts in glass conference rooms, balancing their portfolios, and building their nest eggs. Some great freaking writing, all props, right? They are me, I am them. We are all watching CNBC together, and we are all in the know. It's a nice place to be, and that should be your first clue that it isn't real. A great final line, and that should be your first clue that it isn't real. Now, in my world, I write about trend following trading. This is a technical approach, a reactive approach. It's simply about following the market price up or down. You're completely agnostic to all of the nonsensical ramblings that one might hear on CNBC. And I read that piece because I thought that piece went deeper than just the typical kick CNBC in the ass. That was a deeper piece that really got at the real true essence of the show, of the program, of the channel, and us, the people that watch. What's really going on? Let me give a great example. And of course, a classic example. I literally just caught this segment with Jim Cramer within the last few weeks. Now, as I just said, I am into trend following trading, a very objective, quantifiable type approach. I'm going to let Jim explain the other side of trend following, the other side of technical analysis, a form of technical analysis that indeed is shamanistic.
We know that the Shanghai Composite got absolutely obliterated from mid-June through mid-July, losing roughly a third of its value in less than 1 month. And while the crucial Chinese benchmark had managed to rally for the past couple of weeks, Collins says that the pattern created by the rebound is actually quite negative, not positive. After the gigantic decline in June, he views the rising wedge-shaped rally in July, this is the rising wedge, as nothing more than a bearish consolidation pattern, where the Shanghai Composite was merely marking time before its next leg down. And it's not just the price action. Take a gander at the slow stochastics at the top of the chart. This is an oscillator that helps technicians figure out whether security might be overbought or oversold. Collins notes that the slow stochastics were in extreme overbought territory right before Sunday night sell-off. Right here, you see that? Meaning that in the July rebound, the Shanghai Composite had already run up too far too fast and was due for a nasty correction. Like that, okay? Plus, we also saw a bearish crossover in this indicator, where the black line goes below the red line, which, according to Collins, typically is a sign that we're about to get a short, sharp pullback in the Shanghai Composite. But when you combine what we see in the stochastics with the relative strength index, or the RSI, that's an important momentum indicator at the bottom of the chart, things look even more grim. The RSI has been stuck under 50 for some time, indicating the momentum is now very much in the hands of the bears. Oh, and to make matters still worse, Collins points out that the Shanghai Composite short-term 34-day moving average, that's the red line, okay, has now crossed below its longer-term 55-day moving average, which is a sort of Chinese equivalent of what chartists here call the death cross. In short, Collins thinks the formerly bullish Chinese freight train, all aboard, has now come to a screeching halt and changed direction and is chugging rapidly toward Beartown. But there's another way chartists might view this breakdown, and that's by using Fibonacci ratios. We use every method here. That's the crucial series of numbers that repeat over and over again in both nature and apparently the stock market. Like 23.6, 38.2, 50, 61.8, and 100%. So check out this daily chart of the Shanghai Composite with key Fibonacci levels superimposed on the action. From Collins' perspective, the recent moves in the Shanghai Composite are a Fibonacci trader's dream come true. Remember, before the Chinese market blew up, it was having an epic run. So if you go back to the start of that rally in October of 2014 and you measure through the Shanghai Composite's peak last month, we can clearly see how these Fibonacci retracement levels have played out. First of all, Collins notes that the initial decline from the peak briefly stops at all three. Pretty interesting. All three of the Fibonacci replacement numbers takes a breather after giving up 38.2. Of the previous rally. Then at 50%, we get another breather. And then at 61.8%, we got a third breather. Yes, that actually marks the intraday bottom the Shanghai Composite made earlier this month. The bounce over the past couple of weeks took the Chinese market back up to the 38.2 retracement level, where it peaked at again before Sunday night's breakdown, which guess what? Stopped at, yes, a 50% replacement. I mean, this is retracement. This is incredible. I mean, this is just a Fibonacci nightmare.
I had to end there. I couldn't take it anymore. Please don't beat me up for playing several minutes of it. But if your trading day, if your world looks like that, if that's what you're doing to make decisions, I will guarantee you are going to end up poor. You're going to end up dead, probably, crazed out of your mind, trying to make sense of that type of analysis. If you're using that type of analysis, I challenge you. Show me the performance track record of one trader. Find one trader that's got a professional track record, audited on file with the CFTC or the SEC. Show me one track record that uses any of the foundation of what Kramer just described. Show it to me. You can't. You can't. I'm not being cocky either. Just show it. This is about data. Where the hell is that performance? I want to see the traders that do what Cramer just described. And just to be clear, Cramer was describing analysis from somebody that works with him at his Real Money website. But nonetheless, Cramer goes on TV and gives people 10 minutes of so-called chart reading. That was a great excerpt for demonstrating the original blog post that I read about CNBC. But let me take this discussion further. Let me dig a little bit deeper. The world's largest hedge fund is Bridgewater, run by Ray Dalio. Everyone knows we are in the process of watching China have trouble with their stock market. No one knows exactly what will happen. Perhaps the market will turn around. Perhaps the Shanghai Composite will turn around and race to 7,000. Perhaps it will go to 2,000. None of us know. But recently, Ray Dalio, a long-time bull on China, had this to offer. Quote, "We did not properly anticipate the rate of acceleration in the bubble and the rate of unraveling, or realize that the speculation in the markets was so big by the established corporate entities as well as the naive speculators. We should have." End quote. I'm not sure why Ray Dalio is saying that exactly. As far as I understand, he has a mechanical approach to the markets that uses fundamental data. His current opinion should not matter. Not understanding that perhaps the Shanghai Composite was a bubble, not understanding that speculation could create bubbles. This seems like an odd analysis, an odd statement to lay out there to the public. Speculation is in all markets at all time. And if anyone should know this, and he definitely knows this beyond a shadow of a doubt, it's Ray Dalio. It's an odd statement to me. At first blush, you want to say, well, it's some type of a CYA type statement. I've not looked at Bridgewater performance recently, but it just struck me. If the world's largest hedge fund, one of the most successful investors, is coming out with mea culpas that he misjudged the Chinese stock market, well, what does that say? And if I build off the prior clip that I played from Cramer, where there's this analysis that's attempting to predict what will happen next, Dalio's coming out and saying, well, we didn't predict correctly. Let me take this a step further. I'm actually going to go back a few months because I just saw this quote, but I thought it was fantastic. This is from Charlie Munger, age 91, vice chairman of Berkshire Hathaway. Without a doubt, a man with some wisdom, a man with some success. Let me read. Quote, "This has basically never happened before in my whole life. I can remember 1.5% rates. It certainly surprised all the economists. It surprised the people who created the life insurance industry in Japan, who basically all went broke because they guaranteed to pay a 3% interest rate. I think everybody's been surprised by it, including all the people who are in the economics profession who kind of pretend they knew it all along. But I think practically everybody was flabbergasted. I was flabbergasted when they went low, when they went negative in Europe. I'm really flabbergasted. How many in this room would have predicted negative interest rates in Europe? Raise your hands." No hands go up. That's exactly the way I feel. How can I be an expert in something I never even thought about that seems so unlikely? It's new territory. Munger continues, "I think something so strange and so important is likely to have consequences. I think it's highly likely that the people who confidently think they know the consequences, none of whom predicted this, now they know what's going to happen next, ? Again, the witch doctors. You ask me what's going to happen? Hell, I don't know what's going to happen. I regard it all as very weird. If interest rates go to zero and all the governments in the world print money like crazy and prices go down, of course, I'm confused. Anybody who is intelligent, who is not confused, doesn't understand the situation very well. If you find it puzzling, your brain is working correctly." End quote. Again, that's from Charlie Munger, March of 2015. And what I love about that differently than perhaps what Cramer is attempting to establish, that there's all these chart patterns and this is going to happen next in the Shanghai because this squiggle exists here or this Fibonacci retracement exists there, or Dalio putting an odd mea culpa out saying we should have seen this. Should have seen what? A bubble? We know bubbles happen all the time. But I like that Munger is coming out and saying, we don't know. You shouldn't know. You can't know. Now, you still have to have a strategy. You have to have a strategy that allows you to navigate all of this uncertainty. You need something that's not predicated on knowing what's going to happen next. That is the trick. That is the secret, if there ever was a secret. Let me take this one more step farther. From Seth Godin, predicting the future isn't easy. The best plans are based on trends, not specific events. Here's a hopeless task. There are 18 candidates in the GOP race. If you can rank them in the order they're going to drop out, I'll give you a signed copy of my new book or $10,000, your choice. The chances of being correct are about 1 in 6 quadrillion, so I think the prize is safe. On the other hand, this blog's Twitter account is consistently creeping toward 500,000 followers. If you can guess the date, I'll send you a signed book. Your odds are a lot better on this one. When in doubt, pick projects where the factors you need to have in place are on the road the audience is already on. I give all the props to Seth Godin. He is tying together this thread that I'm weaving in this episode. Smart people. Say what you might about Cramer. He's obviously had a very successful career, and long before he ever got to CNBC. I'm surely not about to criticize Ray Dalio or Charlie Munger. I'm simply taking words and thoughts and connecting them in a way that you can see that prediction is absolutely 100% a fucking crazy, stupid chase for you to be on. You're not going to predict anything. And if I go back to the beginning of this episode with the blog post, CNBC Demystified, Doug Lidowitz, the entire piece was really about this desire, this human desire for prediction, that we can't get away from it. We must have it. And it doesn't exist. Going beyond Seth Godin's great piece about prediction, riding the trend, Leda Braga, and gosh, if I've screwed her name up, I searched for 20 minutes to try and find the exact pronunciation. I could not. But she is perhaps the most successful female hedge fund manager in the world today, a trend-following trader. And she recently was at a CNBC presentation, I believe, a CNBC conference, and she was being questioned about her use of fundamentals or not use of fundamentals.
It occurred to me, I was sitting here this morning enjoying these presentations, and really fantastic lineup of speakers. And as I contemplated some of the slides from the trade IGA side, with all that data on various companies, real estate ownership and EBITDA, etc. And it kind of reminded me of a conference that I did a while ago where, it was a similar form, one-on-one discussion like this. And in the end I said, any questions, any controversial questions? And the guy sitting in the front row said, yeah, I've got a question. The problem with algorithmic trading is that all you've got to forecast the future is the data. And I kind of said to him, well, you think the discretionary guy has what? Crystal ball? So at the end of the day, we're all looking at the data and trying to make investment decisions, right? The algorithmic approach suits itself to certain types of data, certain types of investment process, but at the end of the day, the business of investment management is the business of information management. And I think the algorithmic approach is a very good approach to do it.
I love that quiet confidence in her and just turning around the question to the guy in the audience that thought having all of that fundamental information was going to enable him to predict. It's not. Let me take this a step farther down the path. A great explanation, an audio explanation, from one of the famed original turtle traders, Liz Cheval. She is no longer with us, but years ago I was actually at this first presentation she gave. In this presentation, Liz outlines, she goes down the path of why. What is driving human behavior? Why are we continually going down these wrong paths? And what's really nice about where she goes is she lays it out clearly. We're not going to change. This is going to continue. So if you're already stupid and you're already older in life, you're just not very smart and you believe all this prediction stuff, and you watch CNBC all day long and you get your blood pressure up and you get a little schizophrenic and you get a little crazy and you cheer along on Mad Money. I mean, if you're already brain dead, this isn't for you. But you know what you can do? Of course, you might be damaged goods. You might be a shithead, but you can save your kids. You can save your friends. You can point them in the right direction. Listen carefully to Liz Cheval.
I'm going to start with our natural human investment psychology and a recent example of it going out of control, the technology boom. Everyone remembers our love affair with the NASDAQ. Early in the year 2000, we were convinced that the internet was the biggest revolution in communications technology ever, and that it had changed the investment world. Later that same year, after the NASDAQ had fallen 35% from its highs, we were disappointed, but many people believed the NASDAQ had suffered its severe correction and couldn't possibly go much lower. As you all know, NASDAQ dropped another 70% by the end of 2002. Even those who knew this was coming didn't know when. If we can be honest with ourselves, every investor, every professional investment manager, even the deep value guys, would admit that at some point during the technology boom, they questioned their long-held investment principles and wondered if indeed technology had changed the world forever. Before we examine the specific aspects of our psychology that caused this event, let me answer another question that I think might be running through your mind, which is why on earth is she talking about the tech bubble now? This is important. The answer is because it's still within reach of our short-term memory. We have an opportunity to learn from the actual experience that we all lived through of letting our investment psychology get the best of us, letting it lure us into the bubble mentality. The investment psychology that led to the tech bubble doesn't go away. The same psychology is with us constantly. Let's take another look at the first two NASDAQ charts and substitute market titles in your mind. Think of this as housing today. Less concerted media attention, but basically the same chart. This could be gold. Is the move over yet or not? This is all current. The same psychology that led to the tech bubble influences the markets and the investment decisions we make every day. Important investment decisions about our professional portfolio, our personal portfolio, our family's financial future, and security. So I am going to talk about the psychology of the tech bubble and financial history in some detail. This is the discipline of a professional investment manager. We study our mistakes in excruciating detail. Let's start with a brief review of the internet and a passage from a book that describes this new communications technology that allows people to communicate almost instantly across great distances, in effect shrinking the world faster and further than ever before. A worldwide communications network that spans continents and oceans. It has revolutionized business practice, given rise to new forms of fraud and crime, and inundated its users with a deluge of information. Romances blossom over the wires. Secret codes are devised by some users and cracked by others. Huge fortunes have been amassed, and in some cases lost again as the network takes shape. Attitudes toward everything, from news gathering to diplomacy to prospects for world peace, are being completely rethought. That's a broad and reasonable description of the Internet, right? Except that it was written not about the Internet, but about the telegraph in the mid-1800s. It's from a small book called The Victorian Internet that documents the uncanny parallels between these two communications developments. For every notable stage in the development of the Internet, one can find a direct parallel in the development of the telegraph. The point of the comparison is that as exciting and revolutionary as the Internet has been in our lifetime, in a broader historical context, it is relatively small news. The invention of the telegraph was the real revolution in communications technology. Let's take a look from a historical perspective. For most of human history, the fastest a message could travel was the speed of a man on a horse. This is how families communicated, how news traveled, how business was conducted, even how wars were managed for centuries. Think of this screen as the entire history of mankind. For most of our history on Earth, communications traveled at one speed, slow, until the invention of the telegraph, when overnight it became virtually instantaneous. It was the first time human beings communicated across a continent or an ocean in an instant. Can you imagine how disorienting it was for those living at the time? The telegraph was truly a bewildering and globe-shrinking revolution. The telegraph was the quantum leap in communications technology. Just 20 years later, the telegraph was made obsolete by the invention of the telephone. Now, a mere 150 years after the quantum leap, a nanosecond in human history, we are simply refining the tools. Our love affair with the Internet and our belief that it was history's biggest revolution in communications technology is an example of a specific flaw in our investment psychology, a phenomenon that scholars call chronocentricity. Chronocentricity is the psychological tendency for each generation to believe it sits on the cusp of history. Chronocentricity leads us to believe that what is happening to us is so important it will impact the world deeply and permanently, that it will define a new era. The reality is, at any given time, what is happening around us has happened over and over and over again throughout history. Look at how many times we've done this. Since financial history has been recorded, we have gone through bubbles, manias, panics, and crashes routinely. These are just the major ones. There are hundreds of smaller ones in between. And most of the big ones can be tied to the development of a new technology. The aqueduct in ancient Rome, the telegraph, the railroad, the steam engine, and so on, right up to our most recent tech boom. Why do we keep repeating the same mistake over and over? The short answer is our natural investment psychology. Let me also give you some academic references. In his short history of financial euphoria, the late great economist John Galbraith describes these relentless cycles of boom and bust. Galbraith attributes the non-stop cycle to the breathtaking brevity of the collective financial memory. Galbraith shows that about every 20 years, we conveniently and collectively forget pretty much everything that happened in the previous 20 years, unless it was a huge event like the crash of 1929, and then it takes us about 100 years or a generation to completely forget. This is the third aspect of our investment psychology that fails us. We're chronocentric, we're prone to new era thinking, and we have feeble financial memories. Hopefully you begin to see the defectiveness of our psychology. Many of us think we learned the lesson of the tech bubble because we learned something from our own trading experience, and we are convinced that we will never fall prey to a psychological market phenomenon again. But what I'm talking about is much larger than that. It's not about learning something from the tech bubble. It's about learning that we're incapable of learning anything from the tech bubble. We may have learned something in the short run, but we'll collectively forget it within 20 years. If you are not convinced that we are doomed to repeat the larger pattern, like every generation since the Roman Empire, consider this. In the same short essay, Galbraith identifies the essential features of a mania and outlines the repetitive pattern of these cycles throughout history. It's mind-numbing to study financial history because it is so repetitive. We don't do sort of similar things over and over. We do the exact same things over and over. We have followed this pattern in every major bubble, starting with coin mania in the Roman Empire. Tulip mania is my favorite example because it's just so zany. A period in the 17th century when tulip bulbs became an obsession in Holland. Bulbs were traded on an open market and supported by a paper credit market, virtually a futures market in tulip bulbs. Eventually, a single tulip bulb traded as high as 30 times the average annual wage in Holland at the time, 20 times the price of a small house, for a single tulip bulb. Now surely we're more sophisticated than that, right? Well, the defining features of tulip mania are identical to the features of every market boom and bust, right up to the latest tech phenomenon. I won't take the time to draw the parallels for every stage of the bubble, just the first and the last. The new technology in tulip mania was an improved scientific technique for breeding bulbs that could increase the chances of what was considered a more desirable bloom. The new technology started a frenzy, which spread to the belief that the Dutch had entered a new economic era. The final stage was, as always, when amateurs enter the market. Remember when half your neighbors quit their jobs to become day traders in the late 90s and fueled the final run-up in the NASDAQ? Similarly, it was the Dutch middle class, cobblers, bakers, weavers, and shopkeepers who gambled their life savings and fueled the run-up in tulip mania in the 1600s. Despite our sophistication, our education, our superior technological development, we have the same investment psychology, the same weaknesses, the same devastating natural risk behaviors as peasants in the 1600s. No subsequent generation has learned the lesson of history. We're incapable because we're human. The same natural psychological structure that leaves us vulnerable to the repetitive historical pattern also leaves us vulnerable to other current and constantly repetitive patterns. For example, our obsession with this question: what is the market going to do? There are countless websites, journals, newsletters, and hundreds of hours of television programming every week devoted entirely to predicting what the market is going to do. As if we could know.
As if we could know. She says it clearly, right? As if we could know. We can't know. So many smart people. So many just super intelligent, successful people. And they all think they can know. But they can't. Sure, someone's going to get lucky, and someone's going to get lucky to the tune of billions of dollars. But that doesn't mean that's the best path for you to take. Let me go in a slightly sideways direction. I want to play a clip from Peter Thiel. Great new book out, or at least in the last 6 months or so, last year or so. Great new book. And Peter outlines a view, an economic view that I happen to share. I share his economic view. I share his belief in the men that he speaks about, in the philosophy that he speaks about. First, consider Peter Thiel.
My favorite economists are probably the classic, the classical economists still. Hayek, von Mises. I knew Milton Friedman, so that's probably the one I'm sort of personally the most biased towards. But I think we are going to see some sort of a return to the classic economic thinking of the 19th and 20th centuries. My villain in economics is more clear. I believe the villain is Keynes. There was the Keynes line that in the long run we are all dead. Whether or not that is true, I believe that in the long run Keynesianism will be dead, and that the problem with never thinking about the long run is that in the long run, the short run becomes the long run. And I wonder whether the crisis of 2008, 2009, it was not just a crisis about finance or about technology, but also a crisis about short-run thinking. And it was the point in time where short-run thinking had run out, and there was no more time to think about the short term, and that actually a lot of long-term problems we've been putting off and deferring had finally come home to roost. It's always difficult to describe one's genesis in terms of, it's always difficult to describe where one's ideas come from in various ways. I think I've always been somewhat of a classical liberal. I've always believed in limited government. I've believed that power corrupts and absolute power corrupts absolutely, and that one of the great challenges in our modern and technological age is to figure out ways to challenge the incredible power that human beings have been given in ways that are not corrupting.
I am in complete agreement. I share the political economic philosophy that he describes. But you can't bet on that. You can't make a prediction of when those things are going to happen. You can wait your whole life for the world to reset to the way things should be. But the markets might not cooperate. You might go broke waiting. I'm sure after the late 1979 gold move into the early 80s, I'm sure plenty of people never got out. I'm sure plenty of people held gold all the way down, and it finally came back all those decades later and then went down again. My objective today was to take these many notable people, super success stories, and weave a narrative. To weave a narrative that leads to a clearer understanding about what we all face. From Doug Lidowitz's piece on CNBC, to Jim Cramer talking about chart analysis, to Ray Dalio wondering how he could have missed the speculative froth of the Chinese markets, to Charlie Munger saying, I've never seen this before, I don't know what's going to happen next, and telling people it's okay to acknowledge this feels weird. And actually intelligent people would acknowledge that. It'd be the people that are trying to say they know what's going to happen next are the ones that are not intelligent. I love Munger's perspective for that. Seth Godin adding in the great way to think about trends. Leda Braga pointing out crystal balls. They don't exist. Liz Cheval laying out the human psychology, the human behavior elements that don't change. The foundation for why. Peter Thiel for describing what I believe is a sound economic thought process. But even if you have a sound economic thought process, it might not go the way the markets go. So you still have to make a bet. You still have to trade. You still have to invest. And if your particular economic philosophy, your political philosophy doesn't go the way of the markets, you can lose all your capital. And I'm in this game to help people to understand how to protect their capital and grow their capital. I see a time when those awake will understand how to make money up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.